What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Hello, everybody. Happy Thursday. First up, let's talk about China's economy. Now, we have more new data about the performance of China's economy in November. We can see that there has been very little rebalancing in the economy with weak consumption. Now, we shouldn't be surprised by this. Most economists have been anticipating this over the last few weeks, and many top leaders and officials over the last week or so, particularly since the Central Economic Work Conference, have been concerned with weak demand in the country. Retail sales, a proxy for consumption, were up by only 0.22% month on month for an annualized 2.7% increase, while industrial output was up by an annualized rate of 4.5%. Now, why does this matter? Well, because policymakers have been trying to rebalance the economy more towards being consumption-led for some time now. In fact, this is a key objective of Beijing's economic policymakers and has been since early 2020. And frankly, it has been the case for over 10 years, but it's been a priority since early 2020 with the outbreak of the pandemic. This data shows us that the gap between consumption and GDP has widened. Now, on this point, China finance expert and professor at Peking University's Guangzhou School of Management, Michael Pettis, expressed today, quote, "What this suggests is that while there has been some rebalancing this year, retail sales grew faster in the first 11 months than industrial output did. This has only partially reversed the huge worsening of the consumption imbalance last year. We will return to 2019 levels of imbalance, in other words, by 2023 or 2024 at the earliest. This doesn't bode well for Beijing's attempts to get debt under control in the next 3 years without causing a very sharp slowdown in growth." End quote. Yesterday, several sources were reporting that a group of 19 people comprising embassy personnel and dependents from Lithuania had left Beijing or in the process of leaving Beijing. One diplomatic source told UK-based Reuters that their departure is, quote, "in response to intimidation," end quote. This morning it was confirmed that Lithuanian diplomats had indeed been evacuated from China. UK-based The Economist reports that Lithuania's diplomats were given until December the 14th to hand in their Chinese identification cards and to have them changed to, quote, "reflect their mission's diminished status," end quote. Not knowing whether the staff would retain diplomatic immunity and not accepting its embassy's demotion, Lithuania told all diplomats and dependents to keep their cards and to leave the next day on an Air China flight to Paris. Now, we've been following the spat between Lithuania and China for several weeks now on China Update, which started when Lithuania took steps in recent months to build closer relations with Taiwan. We also saw last week that the EU has made strong statements warning Beijing against punishing Lithuania, and we observed here that the Lithuania spat may cost China a lot of needed capital in the European Union at a time where Beijing is trying to prevent a hardening in China attitudes in the EU like we have seen in the US over the last few years. We also remember the EU statement from Vice President Borrell last week, quote, "The EU is ready to stand up against all types of political pressure and coercive measures applied against any member state. The development of China's bilateral relations with individual EU member states has an impact on overall EU-China relations," end quote. With the deteriorating diplomatic situation with Lithuania, we will see whether the EU is willing or able to back up their words with actions. Now, in the same The Economist article that we quoted above, the piece also made the following observation, quote, "Pessimistic envoys in Beijing worry that Chinese leaders do not care. They fear that the regime is intoxicated by nationalism, and they also detect a conviction that it is the destiny of a rising China to struggle with a fading America," end quote. Now, for you guys who have been watching China Update for some time, we know that this is indeed a mainstream view among many of the Beijing elite. Now, this all touches on our next development to a large extent, which is the quote of the week. But quickly, guys, if you're enjoying the content, don't forget to hit the like button. It's the only way a small channel like this can be seen by more people. And if you're getting some value from the episode and you're watching for the first time, maybe consider subscribing. You'll have the most up-to-date analysis on China every day if you just hit that bell notification button. Okay, plug over, let's continue. So the quote of the week is from the highly influential editor-in-chief of the state-run Global Times. He wrote this piece on Taiwan in English, suggesting that it's for an international audience. This is what he had to say. Quote, "Once the Chinese mainland engages in war to liberate the island of Taiwan, and then the People's Liberation Army launches a full reunification by force operation, then, I believe, it will be resolved in a matter of hours. There will never be an effective resistance from the Taiwan military, nor will there be real assistance from the United States and its allies. As soon as the mainland's reunification by force operation begins, the basic capabilities of the Taiwan military will be quickly destroyed, and there is little hope that reinforcements will arrive. Whoever continues to resist will be wiped out." End quote. Okay, next up, we have been discussing calls for greater self-sufficiency and general isolationist attitudes for months now on China Update. This was a major theme in the Central Economic Work Conference last week. Top leadership expressed that, quote, "Securing the supply of primary goods such as agricultural products, minerals, and energy," quote, "was one of the 5, quote, significant theoretical and practical issues to prepare for amid the pandemic and the changing international environment," end quote. For those of you who are curious, the other 4 priorities are common prosperity, capital regulation, defusing major financial risks, and carbon neutrality, all of which we have discussed on here and we will continue to follow in the future. Now, General Secretary Xi Jinping even spoke on the importance of self-sufficiency in recent days, expressing, quote, "We should make clear the strategic baseline of self-sufficiency in key energy resources. We should fortify the National Strategic Materials Reserve System to secure minimum needs at critical moments," end quote. And yesterday, the central-run Economics Daily published a special commentary on page 1 discussing the importance of greater self-sufficiency in primary inputs and criticizing Chinese over-reliance in foreign oil, iron ore, and soybeans, among other things. The piece expressed, quote, "China's economy is also facing the triple pressure of shrinking demand, supply shock, and weakening expectations, and the current external environment is not favorable to China," end quote. Okay, Evergrande and more developers are in trouble. Chinese financial media outlet Caixin Media reports that yesterday the provincial government of Guangdong, the region of southern China which hugs Hong Kong, dispatched a working team to China Evergrande Group's headquarters to audit the company. The paper reports that Evergrande's management was told to report directly to the working team. It is understood that many executives offered personal guarantees for Evergrande's financial obligations, and they may not be able to meet these obligations. As we've been saying for months now, however, this housing crisis is not about 1 or 2 bad actors. Its roots are deep across the entire property development sector in China. You guys know that we've been following the crisis with yet another developer, Shimao Group, for almost a week now. In a piece today, Bloomberg interviewed the head of Asia Credit at the Swiss bank Lombard Odier, who expressed, quote, "A collapse of Shimao will be far worse than Evergrande in our opinion. Evergrande was known to be a highly leveraged entity, but if a high-quality firm across hospitality, services, and development focused on high-quality markets such as Shanghai can't survive this crisis, then global confidence will be permanently lost," end quote. The Chinese developer Shimao Group may also have new political trouble to add to its financial difficulties. On Tuesday evening, the Shanghai Stock Exchange sent a letter to Shanghai Shimao, a mainland-listed subsidiary of Shimao Group, asking it to explain the sale of a 1.65 billion RMB, approximately $259 million US, property management business to an affiliated party. Today, Shimao Group shares did see a soft rebound in the stock market, but this was likely due to the fact that its shares have already collapsed to a 10-year low this week. Now, along with Evergrande, Kaisa, Fantasia, and Shimao. We have yet another property developer to follow now. It's being reported today that Guangzhou R&F Properties Co, its Mandarin name is Fuli Dichan, is asking holders of a $725 million note maturing in January to extend the due date by 6 months. If unsuccessful, the Chinese developer may risk default. So yet another Chinese developer may be at risk of default. Guangzhou R&F Properties Co has about $31 billion of debt. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.